All right, it is officially 10 a.m. Pacific, 1 p.m. Eastern, so we'll go ahead and get started. Welcome to the September 2012 edition of BALLE's Community Capital Webinar Series. My name is Alyssa Barron, and I serve as Managing Director at BALLE. We have about 65 communities from across North America registered for today's webinar, and we're delighted to have you all with us. I'm going to review a bit of housekeeping, provide a few reminders about this webinar series, and then I'll introduce our topic and speaker for today. So if you're dialed in by phone but you have not yet joined us in the webinar room, you can find a link in your reminder email from Allie Walker. Because of the number of webinar participants, we have the phone line muted. So if you have a question for the presenter at any time during the webinar, you can type your question in the public chat window. Leslie may answer a question as she presents, but we'll hold most questions to the end of the webinar when we have time set aside for moderated Q&A. If you have technical difficulties at any point, please note this in the chat window, and our staff member, Allie Walker, will send you a private chat to help you get sorted out. The private chat will show up as a tab to the right of the public chat window in the top right corner of your screen. And that corner of your screen will flash red once the private chat has been initiated by Allie. After each webinar, we email everyone registered a link to a full recording of the webinar along with presentation slides and a copy of the questions from the chat. So please watch for these materials in an email from Allie Walker over the next few days. So now a bit more about our series. This series launched in 2011, and we're delighted to be continuing it throughout 2012 and into 2013. These webinars are held the second Tuesday of every month at this time, 10 a.m. Pacific. The series is co-hosted by RSF Social Finance with advising from a wonderful group of community capital pioneers listed on our series website, and it receives underwriting support from RSF, Portfolio 21 Investments, Main Street Resources, and Solidago Foundation. These community capital webinars are explicitly focused on tools you can take home and try out right away. Each month we feature a case study with a community capital innovator, someone who has developed and piloted a working model for connecting local people's investments in businesses and farms to local needs using local resources. The innovators present their model, and we always allow time for dialogue and questions. We suggest you treat these webinars as an opportunity to bring together a group of business owners and others, social entrepreneurs, lenders, philanthropists, investors, folks in your community who may be interested in the topic. After listening to the webinar, you might spend some time discussing with your group the applicability and relevancy to your community. And we now are aware of a dozen or more communities who are regularly doing this each month. So we encourage you to use these webinars as a catalyzing tool in your home place. Within the next week, we'll be posting our October through December webinar speaking lineup on our website. So remember, you can sign up for individual webinars, or you can get a significant discount by purchasing all three at once. So we're working on topics like the latest on the Jobs Act and its crowdfunding provisions, including where the feds are with development of regulations that will approve as intermediaries the explosion of new online crowdfunding platforms. We'll look at the sharing economy and explore the latest from the time banking world. And finally, we'll explore a revolving loan fund model created by a CDFI that supports local businesses and provides a mechanism for unaccredited investors to invest in their home places. Full details about our series, including the topics for the forthcoming webinars, which will be announced again within the next week, are on our website, livingeconomies.org. So on to today. Today's call features Leslie Ackerman, Director of Business Sense at Alternatives Federal Credit Union in Ithaca, New York. Some of you may have heard a bit about the program Community Partnership Lending at our Accelerating Community Capital Workshop in Grand Rapids. We're going to go even deeper with Leslie today. And this is a really terrific model, lending model that was developed 15 years ago by Alternatives, starting on making loans to individuals or businesses, or starting with individuals, who may be considered unlendable by typical banking standards. After all of these years of experimentation, Alternatives is moving into the applicability of this model for small businesses as well, and we're really excited to bring the model to more communities. So with that, Leslie, I am going to find you in the list of participants here so I can turn the floor over to you and we can pull up your slides. So hold on, let me pull up the content. And where are you? Here you are. So I've given you the floor and I welcome you to take us away.
All right, very good. Thanks, Alyssa. Good morning and good afternoon, everybody. I am really thrilled to present today. As Alyssa said, this is a model that we've used for a variety of different lending purposes, and we're exploring new ones. And one of the reasons I'm so excited to share this program is because I think it's got infinite possibility. It could be used for just about any lending need, for just about any target audience. Excuse me. And the possibilities just depend on what your organizations and communities see in your communities and want to address. I want to say just a couple of things before I start. One is, as Alyssa mentioned, to date we've mostly used this program for personal loans, not for business purpose loans. What I'm going to do today is talk about its background and how the program works, and then explore how it can be used, expanded for business lending purposes, and even for community investments. The second disclaimer of sorts that I want to throw out there is that I'm actually not in charge of this program. I run our Business Development Resource Center for the community. So I work with small businesses, I teach businesses, we consult with them. I'm more of a cheerleader for this community partnership lending program and not involved in its administration. There may be technical questions that some of you have about the program that I'm not able to answer, and if that's the case, I'll be sure to get that info and pass it on to Alyssa and Allie so that they can include that in the materials that get sent out. So with that, I'm going to start with a little bit of background on the program, where it came from and how it works. And I welcome questions throughout and at the end. So essentially where this came from, as Alyssa said, there are borrowers who can't necessarily be served with traditional bank loans and other kinds of typical lending options out there. Those are often going to be low income or unbanked people, people with poor credit histories, sometimes with unusual borrowing needs. Whatever the issues are, they're considered high-risk borrowers by traditional or mainstream financial institutions. Now, we meaning Alternatives. Alternatives is a community development financial institution, and we've always tried to develop loan products to address the needs of higher risk borrowers, but that doesn't mean that any loan to any borrower is going to be possible. This was frustrating, obviously. We wanted to see if we could meet these needs. At the same time, we had partner organizations in the community, not-for-profit organizations, social service agencies, other entities in our area that were serving clients who had identified financial challenges and clear financial needs. And some of these organizations thought, how can we address these needs? They, in some cases, even had funds available, but didn't have the capacity to establish and run a loan program. So we put ourselves together and we said, let's partner, let's bring both organizations together, use the strengths of each to create a partnership lending program. And I'm sorry that partnership lending down at the bottom there was supposed to be big and bold and snazzy. And my slide is kind of fancy. There we go. So the strengths of each organization, the community organization there had the clients, they had a view of what those clients need, so they came to the floor with a lending objective. Financial institution, that picture right there is Alternatives Building in Ithaca. Financial
Leslie,
yep.
I'm going to interject. Your audio has just gone warbly, like you were underwater. And I've confirmed that the participants are hearing it too. So I'm going to suggest that you just hang up and call right back in. If you have an alternate phone to call from, you might try that. And we'll just hang tight and look at your cute graphics while you dial back in.
All right, I'm going to do that.
All right, everyone, hold tight. And thanks, everyone, for flagging you were hearing it too. Give us just a second more. I don't see Leslie dialed back in, but we'll jump right back in as soon as she is. We always figure it's better to nip that in the bud than to just hope it gets better and all not be able to hear anything in the meantime. Give us just a second more. I imagine Leslie may be scrambling to find an alternate phone line. Oh, Leslie, it's telling you you're entering an invalid passcode. All right. Well, as folks may be seeing in the chat window, it sounds like Leslie's having a trouble getting back in. In a second here, I will just conference her in on my own phone, and then we'll be off and running again. So we'll give her just a second more. Make sure we get good audio here, and if she can't get in independently, I'll dial her in directly.
Leslie Ackerman.
Leslie, we can hear you, and you do not sound like you're underwater anymore.
Thank goodness. Well, I called in on my cell phone. Hopefully the battery will hold out.
All right. Well, thanks very much, and thanks everybody for hanging through that. And hopefully the tech gods will continue in our favor. So you were on your Why a Partnership slide, Leslie.
Yes.
And
should I start again, or are we okay to go from here?
No, we caught it. You were just maybe 20 seconds into not being understandable. So maybe start again with your Why a Partnership slide.
Okay, terrific. Why a partnership? Well, as I was saying, the idea was that we would be able to use the strengths of the two organizations to create a loan program and meet needs of folks who might otherwise be unlendable. What the community organization brought to the table was the relationship with clients and an identified lending need. And the financial institution, in this case alternatives, we were bringing the infrastructure for lending. That is to say, we had the capacity to run a loan program. So looking at each of those with a little more detail, the community organization, they've been working with clients. They know what the clients need. In some cases, they're looking at addressing something that they haven't found a way to address. In some cases, they had money already available. They perhaps didn't want to use grants, or rather issue the funds to their clients as grants. So they wanted to develop loans. But running a loan program, if you're not set up for that, is quite a lot of administration and pretty challenging. So that's where they were coming from. On our end, the infrastructure for lending, the account systems, all of that exists. But as I was saying, not all loans can be made. Even for a community development financial institution, federal regulators are going to crack down if you've got really high-risk loan portfolios and if you're finding that you're experiencing high loan losses. Put them together, and here's what we ended up with: a program with our funny little schematic there that we called Community Partnership Lending, whereby the community organization raises funds. They're put on deposit at the financial institution which makes the loans. I'm going to talk about this in more, I lost my slides. There we go. In a little bit more detail. How does it work? Starting with the community organization, as I mentioned, they raise money to lend. Some organizations already had funds. Some were able to find grant sources. Some have done specific fundraising for a loan program. They develop the lending policies, and this is really important because the organization is out there in the community with the relationship with the clientele, with the lending objective that they have. So they're the ones who have to say, here's what we want the lending to be for. Here's what we want it to be about. Some of the programs that we've had in the past excuse me, have been for purposes like car loans for folks who were in Wheels to Work programs and they were looking to get off public assistance. They wouldn't have qualified for car loans through traditional channels. Another example was for folks to borrow for security deposits when they were getting out of subsidized housing. There's not any real traditional lending model for security deposit personal loans. Alternatives that folks had would have been predatory sources of lending, and of course we were trying to avoid that. So the organization makes the develops the loan policies and the purposes, and they make the loan decisions. That is to say, in banker speak, they're doing the underwriting. They review the applications. They decide who gets approved and who doesn't get approved. So essentially, the applications go to them, and they get to say yay or nay. On the banking end of things at Alternatives, the funds that were raised by the partner, by the community organization, are taken on deposit, and those represent a loan loss pool. That is to say, if the loans are unpaid, if a borrower defaults on the loan, that deposited money is going to be used to pay back the loan. This is why a regulated financial institution can set up a loan program like this, because the risk to the institution is extremely low. Basically, the loans are very, very well collateralized. If we lent 100%, that is to say the organization puts, let's say, $10,000 on deposit, and we agree to loan up to $10,000 to their program, that would have been all the loans 100% collateralized. In a lot of cases, we would lend up to double. So if an organization had put $10,000 on deposit, we would lend up to $20,000. That's still really good security and really low risk for the financial institution, because we'd have to be completely lent out, that is all of the $20,000 available lent, and still have 50% of the loans default before the credit union would have any of our funds at risk. So again, this is how it can be possible for a financial institution to set up a program to make risky loans. It's because the loans are so well collateralized by the security of the loan loss pool of funds that's on deposit. The other main role we play is managing the accounts themselves. We do all the servicing. That is, we set up the loan accounts, we make the payment to the borrower, provide the funds for them, we collect payments, they get monthly statements, and very importantly, the loans and the loan activity gets reported to the credit bureaus. And we'll see in a moment why this is really cool. So looking back just again at that schematic, summarizing, the community organization up there in the top left, they raise funds, they put that on deposit, they develop the lending objectives and the lending policies, they make the loan decisions. The credit union makes the loans, we pay the funds out to the borrowers, and we manage the loan accounts. And there we have our happy borrower down in the bottom with his loan proceeds. Why is this cool? Well, for the partner organization, obviously they're able to achieve their mission-based objectives. If they're trying to provide services to their clients that have a borrowing or a financing need, this enables them to do that with much less hassle to themselves. For the institution, that is to say the financial institution, us, we've got an access channel to clients we might not otherwise be able to reach. Our mission, Alternatives' mission, is to provide financial services to underserved peoples and communities. But it's sometimes really challenging to meet access unbanked folks. They're not on our radar. So this is a way that we can provide financial services to additional folks who we might otherwise not be able to reach. Obviously for the borrowers, they're able to access financing they might not otherwise have been able to get, or maybe at high cost with predatory sources. And as I mentioned, because the loans and the loan activity are reported to credit bureaus, this is an opportunity for them to build or rebuild a positive credit history. And that's really beneficial when we've got folks who are high risk. They're able in a lot of cases to move towards a future that's going to be more financially solid for them. So now that's the past. That's looking at it in our past uses with community partners who were social service agencies for the most part, other kinds of not-for-profit organizations, and for personal lending uses. Now let's think about small business uses. I think most of the most of the folks listening in are probably thinking about business financing. Looking at entrepreneurs, in a lot of ways they fit an ideal target for this kind of lending. They have cool ideas, they have businesses they want to expand or in some cases start. But like the client base we were talking about before, they're often really high risk. They might be low income. They might not yet be seeing a reliable income from their business. Could be seasonal or sporadic. They might need strange loan terms. And that might make them really challenging as loan clients for traditional mainstream lending. So it's an ideal situation. Yes, I would say this could be ideal. One of the things, actually I'll give you two examples of ways that we're considering and exploring partnership lending for business purposes. One is with Slow Money, so food and agriculture loans. Our Slow Money Central New York has been developing loan policies and developing a program that would enable us to partner with them and make this kind of loans for food and agriculture businesses. Another one that's still in the discussion stages is with our Community Arts Partnership. This is a not-for-profit organization that provides support and resources to professional artists in the community. Artists, like a lot of other kinds of entrepreneurs, are going to find that borrowing for business purposes is really challenging. They often have very up and down income. And there's currently no program through the Community Arts Partnership to provide loans. And so this is something that could be another cool small business purpose for community partnership lending. Well, the next question that pops on in my thoughts is, what about investors? This is something that we have not yet put into play, although we're looking at how it could work with the community partnership lending program with Slow Money. It could be an investment, a mechanism for investment by you and me, by all of us, trying to figure out how do we put our money directly into businesses. Lending is fine. Yes, we want to get access to capital for the business owners, but we also want to put our own capital on Main Street, not Wall Street. Well, if we think about how this program is funded, it's got funds coming in from the community partner, and I mentioned that sometimes those would be from grant sources, sometimes they would be from operating funds, maybe even from a social enterprise the community organization operates, but they could be from private capital, from private investors like you and me. If the funds are raised from individuals, they're put on deposit. Remember what happens to those funds. They're put on deposit at alternatives or at the financial institution. They're in a regular certificate account, which I'll disclaimer here and say that I'm not a securities lawyer, but it seems to me that we're going to avoid the securities issues that we've all seen being challenging in direct investment into local businesses, because it's an account that's going into a financial institution. Oops, my slides are advancing themselves. That's exciting. Anyway, this is the way that we.
Sorry.
Okay, no problem. Anyway, this mechanism, because the funds are going through a financial institution, we've got them on deposit in a regular financial deposit account rather than as equity investment or direct lending to the business. We're going to come back and look at that some more and see how that works. So before we do that, though, I want to talk about a little bit about some of the detail. There are, the devil is always in the details, and this is where some of the questions come up. I see that a few have already popped up. The organizational structure. What I'm talking about there is the partner organization. Who would that be? I mentioned that in the past our partners have been mostly social service agencies and not-for-profits, but here's some examples of who might be the partner organizations if we're talking a small business lending purpose. Many of you are coming from BALLE networks, perhaps some of you from other kinds of community organizations, chambers of commerce, trade or professional groups. I mentioned CAP, the Community Arts Partnership in our community. The challenge is if you're thinking about putting this program together and you don't have an existing organization that would be the partner. And for example, that was something that was faced by our Slow Money Central New York folks. At the time we started discussing this, Slow Money Central New York consisted of people who were interested in developing a slow money program, but not any actual legal structure to this organization. So if you've got a group or a variety of representatives from different organizations or whatever you have thinking, let's do it, you still have to address the question of who is the partner organization. You're forming an obligation and a financial relationship here with a financial institution, so you want to actually solidify and clarify the structure of that partner organization. The next issue is about the financial risk. As I mentioned, we've already explored this a little bit. The funds that are put on deposit by the community partner organization are the funds that are in the first risk position. If a borrower doesn't pay back their loan, those funds are going to be used to repay the loan. This is how the financial institutions are able to make the high-risk loans. It's an important consideration, though, for the community partner when you're looking at loan purpose and when you're thinking about what your policies are going to be and how you're going to underwrite loans. Every loan that defaults depletes the funds that are going to be available to others who want to borrow, or it's just a loss to the organization. How much risk is your organization willing to take? It's terrific if you're able to make higher risk loans to individuals who wouldn't be able to borrow, but you do have to consider that your funds are probably, like most of ours, your funds are probably limited. How much risk is enough? How much is too much? If you're looking at getting investors in here, the question is even more complicated because the investors, of course, aren't going to want to lose their principal. They're even going to want to earn some interest on that. How that can be structured, that's going to be explored in just a moment. But how much risk is too much? This is critical. So keeping in mind that the original deposit is at risk is really important. Now, how are program costs covered? I saw that a question popped up here already. A loan that goes out is going to have an interest rate attached to it. Every financial institution charges interest on loans, and they typically charge more interest on loans going out than they pay on deposits coming in. And this interest rate spread is how a financial institution is able to sustain itself. We've got an interest rate here that's a little funky. It's got to cover the costs of the financial institution in administering the program. There may also be administrative costs that your community partner organization incurs, particularly if you're looking at launching a sizable program. And then there's the question of interest earned on deposited funds. And all of that goes together into an interest rate that the borrower is going to pay. Let me give you an example. For alternatives programs in the past, we've typically had the community partnership loans going out at 6%. We calculated that 6% was going to be adequate to cover the costs that alternatives incurred in running the loan program. Most of our partners said, we would like 0% interest on our deposited funds because we would rather see the loans go out to the borrowers at the lowest possible interest rate. Some, however, have said we'd like to earn 1% or we'd like to earn 2%. These days, no one's asking for 2%. But in any case, that gets added on to the 6%. Now, if you've got investors involved and the deposited funds are actually investors' funds, they probably want to earn a few percent as well. that could get your loan interest rate out at 9 or 10% or more. For some kinds of loans, that might be reasonable. For others, that might be really high. Pardon me. And that means we've got to consider, is there a way that we can balance the the competing interests, I should say, so that we can make a competitive rate that's reasonable, that's affordable for the borrower, and that's still going to cover the costs and the demands of investors if we've got investors involved. It could be that we can lower the interest rate overall and charge an application fee. That's something that we've considered doing because we recognize that most of the administrative costs of a loan program are at the beginning. You're setting up the loans, and after that, assuming someone's paying regularly, the cost of covering that, of servicing that loan is lower. So perhaps, for example, you could charge 4% and an application fee. In any case, this is clearly a key question that has to be explored with the financial institution. They have to understand what their costs are going to be. You, as the community partner organization, have to identify any administrative costs that you might have, and if you've got investors or a need to earn some interest on the deposited funds, then that's going to be an additional interest expense that the borrower is going to pay. Finally, the loan policy question. I mentioned before that the community partner, in this case, whatever organization is looking to make these small business loans, the community partner develops the loan policy. This historically has been the biggest challenge for our partner organizations, and the reason is that they're not lending organizations. They don't have any experience developing policies. So we work with them typically to help them figure out, first, identifying what their objectives are. Are we going to target a specific type of borrower or a specific type of use? We're looking at women-owned businesses. Are we looking at rural businesses, minority-owned businesses? Are we looking at businesses in a particular sector? There's, for example, a bunch of BALLE building blocks, and you in your community might say, gee, this area doesn't usually have good access to business financing. Let's target that. What purposes, what business purposes could the funds be used for? For equipment? For working capital? What kinds of loan amounts? Of course, that will depend in part on what funds you're able to raise for the loan loss pool, that is the lending capital. Are we going to have a minimum loan size? Are we going to have maximum loan size? Does everybody have the same term, 3 years, 5 years? Are there going to be variable repayment terms? What about lines of credit? This, again, is a discussion to have with the financial institution. The lending criteria would be, what are you evaluating the applicant on? For consumer lending, like the kinds we've typically done for this program, it's pretty straightforward. You've got income, you've got existing debt, credit history, throw it in your snazzy loan calculator, how much can we lend this person? Business lending is much more complex because in a lot of cases, if not most cases, you've got a business that doesn't have necessarily a straightforward income stream, and so gauging the ability to repay a loan is more challenging. Are we going to be requiring that all the applicants submit business plans? If we're looking at low income or otherwise financially disempowered businesses and entrepreneurs, do they have access to the support services that are going to enable them to develop the business plans and the financial projections? Finally, of course, we've got to figure out how we're going to process this all. What documentation do they need to submit? Do we even have an application form? What does the financial institution need in order to process it all? What's the time frame? Who's doing what? And how will this get put together? So those are some of the nuts and bolts, and I think there are going to be more questions coming up on those, which we'll explore in just a moment. But before I wrap up, how do I get started? Well, we've identified the main issues, the main things that need to get done to build a program like this. In the yellow and the green boxes there, those first two pieces are kind of going to happen simultaneously. Who's your community organization? What are you trying to do? Finding the partner institution, the partner financial institution, can be challenging depending on where you are. And the reason is if you're in a small community or a community that doesn't have a locally owned bank, community banks, credit unions, other community development financial institutions, you might find that there's not a whole lot of interest on the part of mainstream financial institutions to get involved in something like this. And that's because there's little or no money in it. So, Big Bank USA is probably not going to want to partner. If you've got local credit unions, community banks, those are the guys to approach first, but keep in mind that by virtue of their size, they may feel like they don't have the staffing capability to run this kind of program. So that can be a big challenge. Developing the loan policies, of course, I already discussed how that can be tricky. Your financial institution partner, you're going to want to pick their brains on their recommendations for loan policies. The cost and interest rates I talked about, setting up administrivia. Now you'll notice that I didn't include on this slide one of the biggest pieces that needs to be worked on, and that is raising the funds. Where is the capital going to come from? Grant funds, investors, other sources that your organization might already have. That's, of course, a really big question as well. So from there, of course, then go. Start your program, promote your program, get it out there, experiment with it, and report back and tell us what you got. And with that, then I'm going to stop and take questions because I think I need a moment to pause.
Thank you, Leslie. So we know you flagged at the top of the call that because this started as a program for loaning to individuals, that it's not a program you've run, but of course we know that you do run the business lending programs at Alternatives, and of course you're also a deep member of the BALLE community, having been a leader in the network in Ithaca for many years, and of course you've come to many conferences, so we're excited to be with you. I'd like to start with one of the first questions we got, but that also gets back to what you were just alluding to, which is, what do you really think motivates a financial institution like Alternatives to set up a program like this and getting really sharp, if the program isn't being originated by the financial institution themselves, but it's, say, a BALLE network or another kind of community organization who wants to approach a local financial partner, what's the sell? What really would motivate that financial institution? Is it profits? Is it altruism?
I think it's mission. I see Tim's question, and it's a great one. For us, it's mission. We're a strange animal in the world of financial institutions. As a community development financial institution, we're mission-driven. As a credit union, we're a not-for-profit cooperative. It may be an easier sell to credit unions than to banks. I can't tell you if your local credit unions are large, they operate a lot like banks, even though they are technically not-for-profit cooperatives. I think if you have in your community a community development financial institution, that's the place to start because they are explicitly mission-driven. That said, we all have financial needs, and if this is a program that can bring a little extra in and not necessarily be costing the institution, that's going to be a better sell. It's not going to make sense to try to sell it as a big profit machine because it won't be unless you're charging really high interest rates and or really high application fees. And I don't think that that's anything that the community organizations out there want to do. So, if in your community all you've got is the big banks, it might be really tricky, keeping in mind that some of them might be looking at Community Reinvestment Act types of programs, and so that might be a direction to sell it since the profit motive isn't going to be the sales pitch to make.
Great, thank you. And we had a question about specifics, just as we understand how the model has been used, and then as you're planning to take it forward with Slow Money Central New York and Community Arts Partnership. But can you give us just kind of a brief overview of, say, an average loan terms for the individual lenders, and then maybe carry us forward into thinking about the level of lending you're anticipating with the Slow Money and Community Arts Partnership partners, the number of lendees, interest rates, level of loans, kind of walk us through historical and planned specifics.
So historically, they've been very small loans. As I mentioned, two really common examples of the types of personal loans we've done have been for car loans, security deposits for new housing, for getting out of subsidized housing. And so those have been loans on the order of a few $1,000s. That of course means that the partner organization can make a lot of loans even with a relatively modest amount of funds raised and put on deposit for the loan pool. With slow money, it's been a challenge. I think that the identification of the size of the need might not match with the funds that can be raised. That is, as we're looking in Central New York at the loans, not at the loans, at the businesses that are thinking, hey, I'm an ag business or a food business and I'm poised to expand and I'm having a hard time getting financing, some of those are well into 5 figures. Obviously, to make a lot of loans that are in the 5-figure range, it means a lot of funds have to be raised for the pool. So that's been not a hiccup per se, but it's been something that has slowed down the launch of the program, because we're trying to determine what should the maximum size be. It's probably going to be under $10,000, but how many businesses out there are going to need loans of that size? Of course, this is something that the Small Business Administration and the USDA and lots of other agencies encounter when they're looking at developing programs to jumpstart businesses or to make financing available. Anticipating the need and then creating a program that meets that need is challenging. So I'm not answering your question very adeptly, and the reason is that we have no loans on the books yet from the program because it hasn't launched. I think the CAP program, that is the Community Arts Partnership Program, is probably going to be looking at loans on the order of a few $1,000s as well. But again, one of the limiting factors is the funds that can be raised. And if the sky's the limit for a given organization, if they can raise lots of funds, then that means either larger loans can be made or more loans can be made.
Got it. So help us again, with the current individual lending experience, and then kind of your planning to the extent it exists now for the small business lending partnerships. Where are the community partners raising those funds from?
That is, for slow money, that's a great question. I'm going to have to get back to you on that. Originally, I have been out of the loop on that conversation in the last few months. Originally, we looked at it as a mechanism for local investment. And so the idea, since slow money has come around or evolved originally around the notion of individual investors putting money into slow long-term investments, the idea popped up as something we wanted to see individual people putting money into. I don't know if that is still being pursued, and that's something that I'll find out and send along in the presentation notes for you.
Great, thank you. All right, we had just a question which I think might have been a clarification of something you just said. With the larger number of loans, will there be higher costs? I think that was a clarifying question.
Yeah, I see that one. That's a question for the financial institution. A lot of the original cost, the sort of overall cost, of course, is going to come in terms of staff time in just establishing the program. After that, you've got, yes, a small administrative cost for each individual loan. So with more loans, there will be more costs. Most financial institutions are going to have that fairly well automated, because the biggest amount of staff time in processing an individual loan is the underwriting, that is to say, the review of the application. In this program, it's the community partner that reviews the application and makes the loan decision. So that's not going to take any staff time of the financial institution, but it will take staff time or volunteer time, as the case may be, from the community partner organization. The actual setting up of the account that the financial institution does, the cutting of the check, the mailing of statements, those things are going to be a really minimal cost because they are typically going to be pretty automated these days.
And what kind of staffing levels or staffing requirements have you seen in the community partnered institutions in the individual loans? Do you have a sense of that?
That's another one that I can try to get some info on. We've had such a variety of community partners, and some of them are in communities, not immediately in our area, out in Buffalo and so forth, so the organizations I'm not personally familiar with. I can try to find out. I will say, though, that most of the organizations have had something on the order of a dozen or 2 dozen loans at any given time, so not a huge number. We're not talking any organization having like 200 loans, which realistically might require a good chunk of a staff person's time, because not only are they finding the borrowers, nurturing those relationships, taking applications, reviewing, making loan decisions, but they're going to be nurturing the relationship after the borrower receives their funds. It's something I kind of glossed over, but this is one of the real assets of this partnership system, in as much as that community organization has a relationship with the borrower, and with that, they're able to really assist the borrowers who run into trouble and really encourage them and try to give them the support they need if they run into financial trouble and are unable to repay their loan. So that could be a good chunk of a staff person's time if there's a lot of borrowers. Again, I know that's a really unspecific answer, and I can try to find some more details.
Great. I'm noting down questions you've said you can ask your colleagues about later that we might additional details when we send out the call recording and and your slides. So let's see here. Somebody has asked here, could multiple people pool deposits together? So this again really gets to where do you raise the funds from that then come through the community partner institution. But the question was, could multiple people pool deposits, or would then the investment become a security and subject to a regulation? Do you know how to answer that?
Well, again, I'm not a securities lawyer, so you should, run this by Jenny Casson or someone for confirmation. But the idea that led us to thinking about using this for investment is that, yes, indeed, if you're pooling funds from a variety of sources, that is to say, if I and Alyssa and 10 of you who are listening to the call say, wow, I'll put $1,000 into this loan fund, our funds are being pooled and put on deposit as a bank certificate. I believe that it then being a bank deposit is going to be outside of the realm of securities issues, because it's guaranteed, in our case, by the NCUA, the National Credit Union Administration, if it were at a bank, by the FDIC, and that takes out the question of securities and needing disclosures and so forth. That said, there may be some other issues that come up that we haven't dealt with yet at this point. The question was also explored in a conversation elsewhere. What if you just get people together to say, hey, let's create an investment club and use this model? That is to say, we want to invest directly. Let's make ourselves into a community organization to do this kind of lending. That would be something to talk again with securities lawyers about, because it's not really looking at the community purpose that the not-for-profit community partners we've worked with have had. So if it's set up as a lending club, it may or may not work within securities regulations, even though it's being put on deposit as a regular bank account. Again, questions for a securities expert.
That's fascinating. Yeah, we've explored in this series over the last year and a half a number of lending club models, and so that's really fascinating to think where someone might innovate by trying to kind of blend lending club approach with this approach and figure out what would be required to do that. Similar kind of adaptation question. Do you think it's possible to adapt this model to provide equity rather than just debt financing possible?
That I don't know. I would say off the top of my head, probably not. And the reason is that it is pretty much by definition a loan program. We're making bank loans through a financial institution. The funds are coming from, not the bank's normal lending capital, but from another source that's put on deposit to provide lending capital. But by its nature, it's a loan program. Thinking about how to restructure it to make it an equity program would be beyond my knowledge of what that would look like, but it's also not clear the role that the financial institution would play, because typically banks and credit unions aren't getting into that kind of investment. There may be some that do, and I would love to hear if people have examples of CDFIs in their community perhaps who are doing that kind of equity investment.
Great. We had a question back when you were talking about, about the interest rates and what it would look like if you're trying to provide a little bit of a financial return to the host institution and a little bit of financial return in the case you were using unaccredited investors. And we had someone pose something that they thought would be theoretically possible that I wanted you to speak to, which was, could you put a small premium rate and then use the dollars paid back for the riskier loans? So in a sense, creating a tiered program or a revolving loan program that could create its own reserves. Any thoughts about that?
I think you certainly could. I mean, one of the things that, obviously this program has its structural limitations, but one of the things I think that's cool is that you can model it after what your needs and uses are. So you could, for example, have two separate programs, and we've had partner organizations that have had that for two different lending purposes. You could just as well have two different tiers. One could be for less risky loans, and they're looking at one interest rate, and another could be a different kind of loan or a different kind of borrower. Financial institutions do that already because many, including alternatives, have tiered interest rates that are based on a borrower's credit score. So, depending on what your criteria are, you certainly could have a higher interest rate or some other kind of premium on the riskier loans, and that would beef up your reserve funds.
All right, thank you. So we talked a bit about how this could be used as a mechanism for, and that very much this was a part of the plan, for example, with your Slow Money Central New York partnership that's in development, to work with unaccredited investors. So we had a question that says, could you talk more about unaccredited investors? There wasn't a more specific question there, so it may be to just kind of revisit that and further clarify what that could look like. We had a follow-up question then from another person that says, in terms of finding those unaccredited investors, might you consider crowdfunding as a means for raising capital for unaccredited investors that then could go into the loan pool?
Sure. Are we looking at crowdfunding? That would be a question for Slow Money, and I can try to see what their process is looking at right now.
Great, I'll note it down.
Yeah. I don't want to delve too far into the questions of accredited and unaccredited securities because it's not my expertise. I don't want to present myself as knowing more than I do. What I would say is the question of whether this is viable as an investment mechanism under current securities law is a question for a securities expert. If it is viable, then I think you could have as many people in there pooled together. The funds that are put on deposit are already coming from a variety of sources when they're raised by the community organizations. Some of them are bringing them in from grant funds, some from earned income, some from other kind of program or donated sources. So there's no reason why the funds couldn't be coming from a variety of community members that are pooling funds together. How that, what kinds of legal loopholes have to be clarified is something I can't address. I would assume, again, this is me not as a securities expert, I would assume that if it being a bank deposit eliminates the whole securities question, then it also would eliminate the accredited, unaccredited question, because essentially the people are making bank deposits they're not making a securities trade. But I got to send that to Jenny Casson or someone else to confirm. You should take that as Leslie's assumption, not as the gospel of community partnership lending securities rules.
Okay, thank you. Now we had a question again about how you deal with risk, and so this may be going deeper. It may be just reiterating what you'd noted before, which was, are deposit accounts in the loan fund program separately at risk in order to cover loan losses from the program?
I'm looking at that question, and I'm not exactly sure what are the deposit accounts in the loan fund program separately at risk to cover loan losses from the loan program. I'm not sure what separately means there, because the deposit account, right now the way they've been structured is that the deposit is made by the community partner. It is a deposit into one loan loss reserve or loan loss pool account. So there aren't really separate accounts in there. That pool of funds is there to cover all of the loan losses they might incur. It could be that Lee is asking about if we had individual investors putting funds in. Maybe Lee, if you want to throw a clarification out there. Otherwise, I'm not really sure how to answer that question, because I'm not sure what was being asked. I'm sorry.
Okay, great. Well, we'll invite Lee, if you've got any clarifying follow-ups, to stick that in there. And we also had a question about, when you anticipate being able to launch the Club Money Central New York and the Community Arts partnerships, such that people can kind of follow what you're doing and get reports on how it's working. So certainly we'll be watching what you're doing and trying to report out through our newsroom and social media mechanisms and such. But can you give us just a sense of what that timeline is, and then is there any documentation about what you're doing that folks could be accessing, or is there a way to get assistance? If they're really excited to kind of bring this model to their home community, is there an easy way for them to access your learning today?
Sure. Those are a couple different questions. The first one about progress. Right now, the Community Arts Partnership Program is still in discussion. So CAP has not developed loan policies, and I'm not certain if they've yet begun fundraising. So it could be months or a lot longer away. As I mentioned, the biggest challenge for any organization in setting up a partnership has proven to be writing and developing the loan policies. I believe that the current situation with Slow Money is that they've written some really nice loan policies, but I don't know where they are with fundraising. So I'm going to get some, please note on the questions I'm following up on for you, I'm going to get some follow-up and see what I can find out about that. But right now my understanding is that the ball is in both of those organizations' courts. If it proves difficult to raise funds right now, there may be an indefinite hiatus, which would be unfortunate, because I'd really like to be able to provide some more follow-up on what's going on. As far as other assistance, we've got a whole host of documents and not templates per se, but info that can be useful for community partners who are out there looking to establish programs. And I welcome inquiries. People can email me directly, and I will see what resources we have that would be useful to forward to them. I will say that the person here at Alternatives with the most knowledge of community partnership lending is in the midst of a big system conversion for the whole credit union right now. So she's not going to be super available in the next about 2 months for extensive follow-up. But we have other folks here with a good amount of knowledge, and so we can certainly see what help we can pass on.
Great. So are you, as a deep BALLE community member and the director of your business lending programs, are you somebody that would be safe to go through in the interim and then you could direct appropriately? I know you've got your email address here up on the slide.
Yes, I am happy to take any initial contacts, and I will get the right people to follow up, or I myself will find the info that's needed or the resources and send those on to folks.
Great. And one final question here before we wrap up. Can Alternative Federal Credit Union only lend in New York?
Well, yes and no. For our traditional loan programs, yes, we're only lending in our county and the six contiguous counties. But for this particular program, we've made partnerships in other areas. As I mentioned, we've had some that were way far in western New York, in Buffalo. That's typically out of our lending area. Some time ago, we had a pilot program that was looking at doing line of credit accounts, and that was something that we had considered doing in other states. So it could, because of the nature of these loans, since it's really going through another organization, we're not limited in the same way to just our usual lending market.
All right. Well, thank you. So I think we're at time. We had one kind of final observation, which I will add to your list of things to note when we send out our call follow-up. So again, after each webinar, we email everyone registered a link to the recording of the live webinar, the presentation slides, and a copy of the chat window. And Leslie has in situ here graciously offered for a couple of questions to also provide some follow-up answers. So thank you very much for that, Leslie. So everybody should watch for an email from Allie Walker on the BALLE staff with those materials over the next couple of days. Again, watch our website. There's some teaser information now, and there'll be much fuller information within the next week or so about our fall webinars in this series. And we just really appreciate your time, Leslie, and your work, and everybody else joining us and asking great questions. So thanks, everyone.
Thank you, Alyssa.
All right. Well, thank you, Leslie, and we'll hopefully see everyone next month.